ICICI Prudential Bluechip Fund. What kind of return potential this fund can bring to your portfolio? What kind of risk potential this particular fund can bring to your portfolio? Let us analyze and evaluate. Hi, this is Ramalingam, Certified Financial Planner from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions so that you can reach your financial goals faster and smarter. Before we analyze ICICI Bluechip Fund, we will understand the large cap category it belongs to in detail. Large cap category, by definition, they have to invest 80% of their assets in top 100 companies by market capitalization. 20% of the assets can be invested in mid cap and small cap if the fund manager deems fit. This fund is actually suitable for investors who has got a high risk appetite because this fund invests everything in equities. As everything is invested in equities, the suggested time frame is 5 to 7 years. 5 to 7 years is basically an economic cycle or a stock market cycle. Compared to mid cap and small cap, this fund, this category will be more stable because it is investing in large cap. Being an equity fund, in the short term, this fund can be volatile and can generate negative return. That is why the main investment objective of this fund is to generate long-term capital appreciation. As we have understood, the large cap category by and large, now is the time to start the analysis. On what basis we are going to do the analysis? What is going to be the framework of our analysis? Let us see. Analysis, I have divided into 3 segments. In the first segment, we will understand the key attributes of this fund, ICICI Bluechip. In the next segment, we will look at the return and we dissect the return from different angles, from different perspectives, from different standpoints. And risk analysis is the third segment. Equally, an investor has to focus on risk also. We will use traditional methods by which we measure the risk, and also we will use some unique tools to measure only the downside volatility. After doing all these analysis, we will share few important observations. In addition to that, we will also discuss, in case if you want to invest in this fund, what additional factors you need to consider. Can we move into the analysis? Here you go for the first segment, attributes of the fund. This particular fund needs minimum of 100 rupees as an investment. Even for SIP, it is just 100 rupees. This fund is there alive from 2008. The benchmark of this fund is Nifty 100 Total Return Index. The fund has got an asset size of 30,956 crores. The expense ratio is 1.70%. Fund managers are Vaibhav and Anish. Portfolio turnover ratio of this fund is 29%, whereas the category average of the portfolio turnover ratio is 159%. Turnover ratio is the ratio by which the fund manager churns the portfolio. So 29% is the turnover. Only to that extent the fund manager invests for short term. Rest of the money is invested for a long term. So buy and hold investing for long term is actually good for a fund because these are the fundamentally strong investment strategies compared to chasing the trend or short term investing or momentum investing are not fundamentally strong investment strategy. So this fund follows predominantly buy and hold strategy, which is good. The total number of stocks held by this fund is 72, whereas the category average is just 49 stocks. So over and above the category, this fund has got 22 additional stocks. That means this fund is over diversified compared to the respective large cap category. This over diversification can reduce the risk, at the same time has got the potential to reduce the return, because over diversification dilutes the return. Whether it is reducing the risk or diluting the return, we have to see in the further analysis. Total number of stocks held by this fund is 72. Top 10 holdings of this fund amounts to 57% of the stocks. Though they own 72 over diversified stocks, in the top 10 stocks alone, the fund manager accommodates 57% of the assets. In the balance 62 stocks, he invests rest of the 43%. What are all those top 10 holdings? They are financially strong companies and they are leaders in that particular sector. ICICI Bank, HDFC Bank, Infosys, Reliance Industries, Bharti Airtel, Axis Bank, L&T, SBI Life Insurance, Maruti Suzuki India, HCL Technologies. These are all the top 10 holdings of this particular ICICI Bluechip fund. Now we will see the sectoral allocation of this particular fund. Top 3 sectors are financial, technology and energy. 3 sectors amounts to 47%. Means the rest of the 53% of the assets are invested in other sectors like communication, automobile, construction, consumer staples, healthcare. It is diversified across those sectors also. Concentration of in top 10 stocks, concentration in top 3 sectors are definitely much higher. This concentration can add more risk. Also, it can add more return. So what does it actually add in? Let us see in the further analysis. Exit load of this fund is 1% if you are withdrawing before 1 year. If you withdraw after 1 year, there is no exit load. When you withdraw within 1 year, if there is a gain, it will be accounted as short-term capital gain and you need to pay 15% tax. If you are withdrawing after 1 year, it will be accounted as long-term capital gain and you will be paying only 10% tax. As we have understood the key attributes of this fund, now is the time to analyze the return. As an investor, return on investment is more important. We should not be carried away by just looking at past 1 year, 2 year, 3 year, 5 year, point to point return. We have to analyze the return from different standpoint, different angle. Let us do that one by one in detail, in-depth analysis. First, let us do a comparison on the benchmark. The benchmark for this fund is Nifty 100. Nifty 100 in the last 1 year has delivered 2.67% return, whereas this fund has delivered 7.39% return. Definitely very good outperformance in the last 1 year, especially when the market is coming down. This fund has reduced the downside risk. That is why they are able to generate 7.39% return. In the last 3 years, again it has outperformed the index by more than 1%. The last 5 years, almost close return. They have underperformed by 0.25% return. In the last 10 years, again it has outperformed the index by 0.75% return, close to 0.75%. So by and large, this fund could outperform the respective index, which is definitely a positive observation on this fund. Now, where this fund stands in the respective category. In the last 1 year, this fund ranks number 6 in this particular category. In the last 3 years, this fund ranks as 13th rank. Last 5 years, 40th rank. Last 7 years on the 7th rank. Last 10 years, this fund is on the 6th rank. So, except for the 3-year and 5-year category, this fund is among the top 10 funds. It is again a positive observation. However, in 3-year and 5-year medium term, this fund didn't do well. Point-to-point return may be misleading. That is why we do rolling return analysis. Rolling return analysis has got many statistical points. I request you to pay attention to 2 rows, which are maximum and minimum in this tabular column. In 1-year category, in one particular 1 year, this fund has delivered 113%. This is the maximum return in 1-year period. This fund has delivered. Also, in 1-year period, one of the worst 1-year period of this fund is 31% negative return. So, in 1-year period, the fund has got the potential to deliver a return in the range of 130% positive minus 31%. So, broad range. If you look at the 3-year range, the best 3-year has delivered 37% return. The worst 3-year has delivered 5.91% return. Best 5-year has delivered 26%, whereas worst 5-year period has delivered 0.87%. The best 10-year period has delivered 20.29% return. The worst 10-year period has delivered 7.23% return. If you look at this data, this proves one simple fact. In the long run, equity is less riskier. Short run, equity is riskier. In the long run, this fund has got the potential to deliver much higher return than FD, much higher than inflation. So invest only for long term. One more data on returns, which tells you how volatile this fund can be. Q2 of 2020, this fund has delivered 24% positive return. In just 90 days, 25% return almost. Q1 of 2020 has delivered 28% negative return. So, this fund is more volatile in the short run. When you are investing in this fund for long term, the road will be bumpy ride. Because it's a bumpy ride, you should have enough conviction on this fund so that you will have patience when the market delivers 28% negative return in just 90 days. And you will continue your SIP, you will continue and stay the course, right? So understand this fund has got volatility in the short run. If you have conviction for long term to stay the course, then this fund can be in your watch list. If an investor would have invested 1 lakh 7 years back in this fund, the present value of his investment will be 2 lakh 13,000. If an investor would have started an SIP 7 years back for an amount of 10,000 rupees every month, then the present value would be 13 lakhs. This is the last part of return analysis where I have handpicked a few strong competitors for ICICI Prudential Bluechip and compared the performance. The last 1 year return, yes, ICICI Prudential tops the chart, 7.39% in the handpicked list. Rest of the funds have underperformed ICICI Prudential. However, in the last 3-year category, the funds, the UTI master share has outperformed ICICI Prudential. Last 5-year category, Axis Bluechip has outperformed. Expense ratio, yes, there are funds like Mirae Asset Large Cap, which has got lesser expense ratio comparatively. Asset size 30,000 crores is a good asset size for a large cap fund. So the observation here is in some particular period, this fund has performed well. In some periods like 3 years and 5 years, there are other funds, competitors have performed well. As we have analyzed the returns in detail, in depth, we have compared it with the benchmark index. We have also seen the rank within the category, rolling return analysis, best quarter, worst quarter analysis. We have done lump sum investment and SIP investment for 7 years. We have done it, and also peer comparison with some key players we have compared. So as we have done a 360-degree analysis on return, now is the time to focus on risk. Analyzing the risk potential is an important aspect in investment planning, because as an investor, controlling return is not in your circle of influence, whereas controlling risk, managing risk is under your control. That way, when you manage risk, you will be able to manage your overall investments and you will be able to control the return. That way, risk plays an important role in selecting an investment. We will use few traditional tools to analyze the risk, and we will use few advanced unique tools to analyze risk. According to SEBI's categorization, this fund is an equity fund, large cap category. As it is investing everything in equity, it is a very high risk category. This fund is suitable for very aggressive investors, investors who are willing to accept very high risks to maximize potential returns over the long term. Important risk measurement ratios I have listed down here. Standard deviation is 21. That means this fund is highly volatile. Sharpe ratio is 0.48. That means this fund has got better risk adjusted return. Sortino ratio is 0.52. That means this fund has got better downside protection. We will see this downside protection with our advanced risk measurement tools. Beta, the risk quotient of this portfolio is almost equivalent to the index, equivalent to the category. Alpha of this fund is 0.33%, which is higher than the category. As an investor, I am paying expense ratio because the fund manager will deliver alpha, additional return than the index. This fund has delivered alpha. And number two, the alpha delivered is lower, but they have delivered alpha. The alpha is 0.33. Traditionally, these are all the tools by which the risk of the portfolio, volatility of the portfolio is measured, especially standard deviation and beta. And I'm going to use slightly advanced tools, unique tools to measure volatility. The traditional tools like standard deviation and beta measure volatility as a total. Means when market goes up by 10%, if a fund also goes up by 15%, that additional 5% is captured as volatility. Though it is good for investor, it is captured as volatility. But the upside volatility is not real volatility, right? Only when the market goes down by 10%, the fund goes down by 15%. That additional 5% is bad volatility. We are going to ignore good volatility, upside, but downside volatility is what we are going to measure using unique tools. So using only the downside volatility, bad volatility, we have sorted all the funds in this particular category, divided into 4 quadrants. Top quarter is the category where the bad volatility risk is higher. Next quarter is upper middle quartile. Next quarter is lower middle quartile. Bottom quartile is where the bad volatility is very minimum and preferred. Now, in the 3-year category, this fund is in the lower middle quarter. That means the bad volatility of this fund is lesser than 50% of the category, right? In 5-year category and 10-year category, this particular fund, based on the risk profile, measurement only on downside volatility. This fund is in the bottom quarter, both on 5-year as well as on 10-year. That means the bad volatility of this fund is less than 75% of its competitors, which is actually good. So downside risk protection of this fund is definitely appealing. Capture ratio is again another unique tool, not a conventional tool, an advanced tool to measure volatility. When a market goes up, how a fund manager is capturing the upside market performance? They should capture higher than the market. When the market goes down, they have to capture less of the downfall. This is what a smart fund manager will be doing. So now if we break how he is capturing the return, that can give you an idea. In the up market, last 1 year they have captured 104%, last 3 years 97%, 5 years 94%, 10-year 96%. Whereas during down market, this fund manager has done extremely a good job. The last 1 year 84% means less than 100, 3 years 92, 5 years 92, and 10 years 90. So downside capture ratio, the fund manager is playing definitely a very good role. The overall capture ratio is more than 1, which is a good sign. 1.23 in the last 1 year is definitely awesome performance by the fund manager. As we have analyzed the risk part of the portfolio, we used traditional tools and also advanced unique tools to understand the risk potential of this fund. Now is the time to make some key observations and insight. As it is a large cap fund, definitely a stable fund compared to a mid cap and small cap fund. And when mid caps and small caps are performing in the market, this fund will not be able to outbeat those funds. And in the last 14-year history is there, so we are able to do a detailed analysis because it has got 14 years track record. Capture ratio shows that this fund has fallen less and recovered faster. Number of stocks held in this fund is definitely a cause of concern, but at the same time, though they have 72 stocks, they have concentrated like more than close to 50% in top 10 stocks and top 3 sectors, which is actually kind of balancing. And rolling return, definitely we have to pay attention, especially in the 5-year category. They have to definitely work on. There are other competing funds which are performing better, and the competing funds are able to deliver more consistent return than this particular fund. These are all some important observation on this fund. If at all you want to invest in this fund, I want to give you few points to consider before you invest. As it is an equity fund, though it is a large cap category, it is an equity fund. So only if you have 5 to 7 years time frame, please invest. If you have money for short term, please don't invest in this fund. Refer your financial plan and find out your investment objective and your risk tolerance level. Based on your investment objective and risk tolerance level, check with your financial planner whether this fund is suitable to your portfolio or not. Also, one more thing you have to do with the help of your financial planner is what is the overlap ratio of this fund. That means as an investor, you may already have few mutual funds, few stocks. So what is the overall stocks you have? Vis-a-vis, what is the kind of new stocks this particular portfolio brings to your portfolio? Because you are adding ICICI Bluechip fund to your portfolio, the ICICI Bluechip fund is going to bring some unique stocks which are not there in your existing mutual fund portfolio and your direct stock portfolio, or it is going to overlap predominantly the existing stocks which you are holding through other mutual funds and direct stocks. If it is going to overlap only, then you can avoid this fund. If it is not going to overlap, it is going to bring unique stocks, then it helps, right? So discuss with your financial advisor or investment experts before choosing to invest in this mutual fund scheme. If you have any questions on this particular fund, ICICI Blue Chip Fund, or any other fund, or any other investment options, or you have any questions on achieving your financial goals or creating long-term wealth, feel free to book a free appointment with our certified financial planner. To book an appointment with our certified financial planner, a link below this video in the description is given. You can click the link and book your appointment. We regularly organize insightful investment webinars with investment experts. If you want to participate in this webinar for free, I have given you one more link in the description of this video. Please click that link and leave your name and email ID. Your seat for the upcoming webinar will be booked and an email will be sent to you in this regard. You can ask in all the webinars your questions to the investment experts. They'll be there to clarify. In addition to that, our investment experts will share their knowledge on long-term investing and long-term wealth creation process. Hope you like this video. Again, I'll meet you in yet another useful video. Thank you. Bye-bye.